The finance industry is filled with jargon. Some of it's unintentional, but I think a lot of it's actually intentional to confuse clients. So we want to break down what we do with our client partners on an everyday basis so they understand what we're doing with their money, but in plain English, not jargon. The first thing that we do is we want to invest in the best businesses in the world. And in doing so, that's executed through public stock markets in either ultra low cost index funds or other quantitative investment strategies. And lastly, we will also invest in the best businesses in the world through some idiosyncratic investment strategies where we think the odds are tilted in our favor to generate market-beating returns. In doing so, when we execute investments in public stock markets, we have an acute focus on tax mitigation and creating tax assets that can be used to offset gains in other parts of the portfolio or even someone's business. Let's move on to number 2. The second thing we do with our client partners' capital is we loan money to private equity funds. Let me dig into that, because I also think for those who are being acquired by private equity, it could help deepen your understanding of what transpires in a public equity transaction. Let me give you an example. Let's say a private equity firm wants to go out and acquire a lawn and landscape business for $100 million. They don't just take $100 million from their private equity fund. They'll actually take around $60 million from their fund. And this is the fund that big institutions or maybe wealth managers have invested in. And it's pension funds, it's endowment funds, and again, it could be wealth management funds that are investing in that private equity fund. So in order to do this $100 million transaction, they'll take $60 million from those investors, and then they'll go out and they'll borrow the remaining $40 million. So where do they get that $40 million? They typically get that $40 million from what I call private loan funds. And private loan funds, they're managed by multi-$100 billion money management firms that gather money from people like me and my clients, from large institutions like, again, endowments and pensions. And what they do is they create a pool of capital. And then this pool of capital and the team, they go out and they analyze this lawn and landscape business in order to determine whether or not they should make that $40 million loan in order to complete this private equity transaction. And so what we do at Essential Partners for our client partners, we'll actually invest in those private loan funds who then go out and make those loans. And currently, we're being compensated anywhere from 9 to 12% on those private loan funds. So a return that's commensurate or greater than the long-term average of public stocks in the United States. The question then becomes, though, since that's ordinary income, that does create a high tax bill, even though you are generating a good return, and it's still appropriate in its own right. But we want to make sure that we have strategies to actually reduce that tax bill on the ordinary income being generated from these private loan funds. At Essential Partners, we actually use investments and utilize technology in order to mitigate taxes on ordinary income and also capital gains well within the IRS code. There's been a number of strategies on the quantitative investment front that have been developed over the last number of years that take advantage of advanced technology. They take advantage of low operating costs through commissions going to zero in stock markets and other securities markets. And they build on the back of historical hedge fund strategies in order to mitigate taxes on your investments well within the code. Let's move on to number 4. We want our clients to own assets that cannot be printed by politicians or the Federal Reserve. In doing that, the way we execute those types of investments are through gold, commodities such as copper, wheat, oil, natural gas, a broad basket of commodities, as well as real estate. So these are all assets that, despite the monetary stimulus and the fiscal stimulus that our government continues to engage in, these are the types of assets that are real assets, and they cannot be printed by irresponsible Fed officials and politicians. So in doing so, I think there's some statistics that are pretty interesting. For instance, gold has increased at a far higher rate than stocks since the year 2000, appreciating around 10 times over that time frame, while stocks, the US S&P 500, has appreciated around 7.5 times. So significant outperformance over that time. The other reason we like owning assets that cannot be printed is because these assets typically perform well when conventional financial assets perform poorly. In other words, when stocks are doing really well, gold typically and other real assets aren't quite performing as well as stocks, and the reverse is also true. Let's go to the last one. And clearly, this is not a comprehensive list of everything we do, but these are some of the core beachheads of portfolios at Essential Partners for our client partners. The last one is loaning money to the US government. Say what you want about the US government. I certainly have my opinion of the irresponsible nature of fiscal and monetary situation in our wonderful country. But at the end of the day, Warren Buffett has $350 billion in short-term US government bonds. That's jargon. What that is essentially Berkshire Hathaway and Warren Buffett are loaning money to the US government. So we do the same thing for our client partners. And look, as long as we have the strongest military in the world and the ability to print our own currency, US T-bills and loaning money to the US government are money good, and we're going to get paid back with our interest in doing so. What I also like about US government bonds is that not only is it earning above a 4% return currently, but it gives us the dry powder in order to buy opportunistically when other asset classes and other things that our clients own might not be performing as well and opportunities arise. So again, this is a high-level view of what we would do with our client partners' money in plain English. It's not everything, it's not all the details, but in future videos, we will dive in to each of those areas in greater depth to understand why do we want to own the best businesses in the world. Tell me more about private loan funds and also other company debt that we invest in on behalf of our client partners. Third point, in thinking about technology and mitigating taxes, understanding those strategies in depth that can not only help at the portfolio level, but can also help in reducing taxes on a business sale. And then the fourth one, digging into real assets and why our clients have an allocation to those assets, as well as the philosophy behind it. And lastly, thinking about government bonds and actually loaning money to the government, especially across different durations, whether that's 3 months to 30 years. So in future segments, be sure to stay tuned because we're going to dig into those topics.